Hello everyone, thanks for checking out my video. I will be traveling again this week and therefore there will not be any video next week. I hope to cover as much stuff as I can for this video. Anyway, S&P 500 has closed 20% higher since it hit a low in October 2022. Based on definition, this means that we are in a new bull market. But is that really the case? The rally in the broader market was likely driven by various mega-cap tech firms, as many tech stocks were flying last week. Nvidia continued its monster run as it was up close to 8%. Tesla finally woke up and gained more than 8%, while Alphabet, Meta, Apple, and Microsoft all hit a 52-week high. The star performer for the week was Palantir, which rocketed by a whopping 23%. As a long-term investor, I am really happy to see my portfolio being so green and recovered so well from 2022 slump. But meantime, I must say the tech sector is very heated right now. But what does that mean? Let's discuss them in this video. The stock market showed more strength last week on debt ceiling deal optimism and easing banking crisis. At the moment, it doesn't seem that the strength will abate as both S&P 500 and Nasdaq hit 2023's highs. But on Friday, the debt ceiling talks were put on hold as the Republicans said President Biden's White House was being unreasonable. Stocks fell a little bit as a result, but still showed relative strength. Maybe because Jerome Powell said interest rates may not have to rise as much as expected to curb inflation. All in all, both Nasdaq and S&P 500 had their best week since March this year and their highest weekly close since August 2022. In terms of market outlook, almost all investors and their dogs are expecting a deal in the debt ceiling negotiations. The reason is very simple. Nobody will benefit if US defaults on their debt. The worst economy will severely affected, and I don't think US will want to lose their credibility or jeopardize their financial position in the world. That being said, if the negotiations were to stretch it to near the so-called X date, which is 1st of June, I think we can expect some wild swings in the stock market, perhaps a bit of a sell-off. Therefore, pay attention to the news as we enter the new week. Next, personally, I will be interested in Nvidia's earnings as they report their results on 24th May. By now, we all should know that Nvidia is leading the way in this AI bubble. Year to date, the stock is up by close to 120%. That's just too crazy, it's very extended. A lot of expectations have been priced in since the start of this AI craze. Therefore, on Wednesday, if Nvidia throws in a stinker or their forecast disappoints the market, they could be punished with a big sell-off. That may have a ripple effect for perhaps AMD, TSM, or even other AI-related stocks like Google, Microsoft, Palantir, etc. But of course, if Nvidia gives us a better than expected results and kept talking about AI, who knows, this extended rally could continue. I mean, nothing seems impossible at the moment, although I am of the view that a modest pullback would be healthy. This type of 100% rally is just not sustainable. Just imagine if this carries on, Nvidia could reach $1,200 by this time next year. Anyway, it will definitely be interesting to see how the market reacts to its earnings. Finally, Jerome Powell mentioned on Friday that they can't afford to look at some data and make careful assessments on the next rate hike. The odds of a Fed rate hike in June briefly hit 40% last week after some hawkish tone from Fed officials. But with Powell's comments, the chance slipped back to about 20% on Friday. So yup, the next rate hike will be something to watch. For information, the next FOMC meeting is 13 to 14 June, and the next CPI release date is 13 June. Moving on, let's now look at the technical charts. Remember in my last video, I mentioned that a huge move is incoming for SPY due to the Bollinger Band squeeze. It's either we get to 396 to 398 range on the downside, or we break above the recent high of 417 and will likely fill the little gap at 419 to 420. There is almost no in between. And look at what SPY did. It did exactly as what was shared by breaking 417 and filled the gap at 420. Anyway, SPY is currently at resistance level as you can see that it hit this area on 2 other occasions recently and got rejected. This is the third time we are trying to break above. Will third time be a charm? 420 is a key level in my opinion. Once that is broken, meaning to say, if SPY starts to close above it, the next target will be August 2022's high at 426. And when that level gets claimed by the bulls, I think you can reconsider your position if you remain bearish of the market. So come this week, I think 420 plus minus a little bit will be a better zone for both bulls and the bears. And oh, just to highlight, MACD had a bullish cross last week. Therefore, to me, momentum is on the bull side right now. With that being said, remember the market is always unpredictable. So let's say the debt ceiling talks give the stock market some nervy moment and creates a mini sell-off, we could start to head towards the gap at 407 to 408. I do see some support for SPY from 406, where the 50 moving average sits, to 408, which is the top end of the gap. Even if this area breaks, I think it will be an uphill task for bears to break the 23.6 Fibonacci level and psychological level of 400. I don't know, if somehow something in the system breaks and 400 gets breached, the gap between 396 and 398 should be easily filled. Okay, as I will be away and there is no video this coming week, so to sum it up for this and next week, the key levels for upside are 420 and 427. The key levels for downside are 406 to 408. When either bulls or bears claim their respective key levels, the momentum is 90% on their side, until of course the levels gets breached again. Moving over to Apple, similar to SPY, Apple has a peekaboo at the top as it retested August 2022's high, which is 175.3. It basically tried to close above it, created a new 52-week high in the process, but retraced back to close the week below that level. Come this week, it's simple to watch. Apple will likely retest this 175.3 level again, and if it can close above it by giving us about 2 green candles, the bullish momentum will continue. In other words, sellers will be exhausted and we could head towards March 2022's high at 178 or even charge towards 180. But, yeah, here's the but. What I observe is that somehow from 175 to 180 range, sellers seem to step up. In other words, investors or traders seem to love taking profit at this level. I don't know if it will happen again, but if it does, then we could easily fall back below 175 again. And more bearish momentum will bring Apple to fill that gap between 166 and 170. This, to me, will not be an area of concern because we have some support here. In fact, just right beneath this area, the 50 moving average, which currently sits at 164, should offer some support. Honestly, while I am away this and next week, I think it is unlikely for bears to bring Apple down to 150's range. But if it does, I will be excited and may consider picking up some shares or sell put options either at the gap between 158 to 159 or the 61.8 Fibonacci support level at around 156. We'll see how. Let's now check out Tesla. Tesla is on this short-term uptrend since it hit 150's range back in late April. It's gaining some nice momentum as it closed above the 50 moving average last Friday, which sits at 178. If we can continue to stay above the 50 moving average early this week, I think Tesla could head towards the resistance level of 190. If this level breaks, I think Tesla could easily touch the 200 moving average at 202. So yup, you got it, 190 is the level to watch this week. If bulls can reclaim this level, I think traders can play the uptrend to 200. Key resistance levels will be 200 moving average itself, as well as the recent high of around 218. Once again, about 2 or 3 green candles above 218 will bring us into this consolidation zone between 215 to 250's range. So yup, hope you got the gist. 200 moving average and 218 are important levels to watch for Tesla to unlock more upside, which stretches all the way to 240's and 250's range. Alright, it's appreciation time again. So in my last video, I shared that there were 2 viewers who signed up for a Weibo account but have yet to deposit any amount, and both of you did it. I hope you have gotten your free shares, and thank you again for your support. There are so many YouTubers promoting Weibo, and I am really grateful to those who chose to support me, who is a small player. I am not even near 1000 subscribers. Anyway, there were 2 more signups using my referral link last week, so to whoever you are out there, I greatly appreciate your support. Alright, so as usual, this channel needs your support, which can be done through either of the following options. The free method, of course, is just simply tap on the like button. I have not been able to achieve 45 likes. The second method is to sign up for a Weibo account using my referral link and deposit $1. You get free shares, I get some rewards too. Promo ends 31st May. God knows whether Weibo is going to extend it further. The last method would be to buy me a coffee at USD $3 via the coffee link below. But of course, do this only if it is within your financial means. Okay, back to business. Let's say we have some nervy moment from the debt ceiling talks and Tesla wants to fall for whichever reason. 159 has been proven to be a decent support in the last 1 month. So there is no need to panic if this level can hold. Just to add on, 1 or 2 days below this level is absolutely okay. But if we have high volume of dumping and big red candles, then the big gap between 146 and 152 will act like a magnet to pull Tesla down. At this point, 146 has to hold, otherwise Tesla will see a waterfall down. Moving over to Google. Let's be honest here, last week I saw that RSI has reached an almost unprecedented level, and therefore I was expecting some form of pullback. It did, but only a very insignificant one on Monday. And then it continued its monster rally till the end of the week. So, yep, I was wrong and I have to admit it. A quick look at the RSI shows that Google went even higher. The other time it was higher than this was in April 2021. And on Friday, it printed a bearish candlestick called Shooting Star. This is usually deemed as a reversal candle that appears on an uptrend. So together with RSI, once again, I am expecting some form of pullback this week. Well, some may say that I can keep saying this pullback until the pullback actually comes and then say that I nailed it. All I can say is that's not my intention. I present what I see and I always stand corrected. This is also the reason why I always paint both bulls and bear side, and I am prepared to accept I am wrong. More on this in the option trade segment later. Anyway, let's say the pullback comes this week. Bulls have multiple support levels below. First, it will be around 120. Next, it will be the gap between 113 and 114. Expect some strong support at the consolidation zone between 103 to 108. I think it is quite unlikely for bears to push below this area. The final strong support stands at 100, and this is where the 200 moving average sits as well. On the upside, as shared last week, if we can close about 2 green candles above 125 with solid volume, Google will easily hit 130's range to fill the gap at 132. That will bring Google into this consolidation zone at the top. Resistance should be at around 135. Anyway, this is very similar to what I have shared previously. Previously, I shared that once Google breaks above the key 108 to 109 area, it will fly towards 120. I covered this in my last video as well. I will link it up at the top right hand corner. So basically, Google did it, it hit 120. Applying the same theory, if we break above 125 convincingly, 130s will highly likely be inside. And yup, this is how you dissect my technical analysis, if you haven't already known. Alright, let's move on to the options trading segment. So, if you had followed my video, you will know that I have a Google covered call option that was dipped in the money. Honestly, I was expecting a pullback last week with RSI being super overbought. In fact, it was the highest since 2 years ago, as covered earlier on. But as always, market can always set new record, and Google went up even higher and brought the RSI to almost an unprecedented area. With this, it means 2 things. 1, pullback is even more likely this week. Number 2, my covered call is even more in the money. So last week I didn't want to take any chance. I decided to trade with the trend, and therefore I wrote my option on 17 May Wednesday before it gets caught away anytime. The original expiration date was this Friday 26 May. At that point, I thought that the chance of my shares getting caught away is getting higher as Google goes higher and as we go closer to expiration date. So basically, I acknowledged the uptrend and acknowledged that I was wrong about a potential pullback last week. And true enough, Google went even higher on Thursday and Friday. That would have put my initial covered call even more in the money, which would have further increased the chance of my 100 Google shares getting caught away at $110. So yep, moral of the story is stay nimble and acknowledge the price action and trend. As the saying goes, it is okay to be wrong, you just need to be less wrong. Anyway, I only managed to roll up the strike price a little bit to 113 where the gap support level is, and the expiration date has been extended till end June. I got a credit of $100+ by rolling this option. Let's see how this trade turns out eventually. Alright, next I have one Tesla trade that is expiring this week. I sold this cash secure put on 26 April, a few days after Tesla gapped down. I covered this in one of my previous videos, but for ease of reference, I basically sold this put option because the RSI was in the very oversold territory and a rebound was likely. At the same time, Tesla was showing strength by holding above the Fibonacci level of 159 quite well. But because it is Tesla, so I was a little kiasu, a Singlish term which means scared of losing. So I chose 130 as the strike price, which is way below the 61.8 crucial Fibonacci level. Could I have chosen a higher strike price for better premium? Well, I could, but that's hindsight. Hindsight is always 20/20. Okay, great. Hope you have learned something from my trades, especially the one on Google. I mean, I thought it was a good experience to show viewers how to save an option that is so deep in the money by rolling it. The last time I actually wrote an option was I think about a year ago when I first started option trading. Yeah, that's how rare I roll an option. But well, sometimes things do go wrong. You can't have 100% record. That's part of investing and trading. Some end thoughts to wrap up this video. From now till the next FOMC meeting, barring any surprise from the debt ceiling issue, I think there is almost zero to very few reasons for the market to tank. Yes, we could have some pullbacks, but I think these pullbacks would be the so-called healthy ones, and they could be opportunity for long-term investors to snap up some shares if they have not been doing so since last year or early this year. As for the bears, sadly, I think the only hope for them to see a significant drop in the stock market is some nervy moment from the debt ceiling negotiations. I mean, we all know that 99% it will be raised, but just that the further it drags on, the more volatile the market will get. Another hope for bears, of course, would be something in the system breaks or some black swan event happens, but we don't even know what that could potentially be. And just to be transparent and honest with my viewers, I was expecting some pullbacks last week, but I was wrong as the various tech stocks continued to rally, bringing RSI to even more overbought zone, and some indicators are really extended. I really expect some profit taking happening soon, and that some of the stocks to take a small break. Well, I could be 1 week earlier as the pullbacks may come this week, or I could be completely wrong and the pullbacks may not even come so soon. Whichever the case, as per my usual saying, don't be stubborn, trade the trend, trade what you see and not what you think. Anyway, I practice what I preach as I wrote my Google option last week because I saw that it broke above key resistance levels. Therefore, short-term wise, it is evident that Google is really bullish and therefore I did not hesitate to roll my option contract, just in case my shares get caught away at $110 per share, which I will earn $1,000 in return, but I will lose out more capital gains. All in all, short-term wise, I remain bullish, while long-term wise, long-term as in till the end of the year or early next year, I am still a little bearish. This brings me to the view that I have talked about since a few videos ago, and that is bearishly bullish. So yep, my view hasn't changed in case you think I flip-flop my words or my view. Although the bearishness in me did drop given that the technical charts are looking awesome right now. Remember, trade what you see, not what you think, and that trend is your friend. However, to completely remove the bearish side of me, I think for now it's not quite there yet, as the macro still looks weak to me. that being said, as SPX or SPY breaks and closes above 4002 and 420 respectively, my bearish view should continue to drop day by day and may eventually get eliminated. Again, gentle reminder to myself and everyone out there, don't be stubborn or too fixated to a particular view. Alright, let's see how the market moves in the next 2 weeks when I am away. We'll provide more updates when I am back from my trip. With that, do remember to like and subscribe, and I will see you in the next video. Thank you.